Good afternoon, everyone. This is Jim Busch. Thanks for attending today's webinar. Today, we're going to review a strategy for uncovering early-stage growth stock opportunities. This strategy uses a mix of technical analysis, fundamental screening, and subjective criteria, and it's been a strategy that I've been using successfully for a number of years now. And even though you can use this at any point during the year, it's also a strategy that works particularly well during earnings season. And before I get too far into it, I'd like to just mention that if you have a question at any time during this webinar, you can submit it to the chat, and I'll get to it as soon as I can in the Q&A portion. So let's just go through the agenda today. I know that we have a lot of people on trial these days, and particularly for those of you who are new to the service, I'll just give you a quick idea of my personal background, who I am and what I do here. And then we'll go into defining an early stage idea, the chart characteristics associated with that, some fundamental criteria I apply to those, the concept of looking for story stocks, and then I'll walk you through a number of examples to try and tie everything together. So quickly, in terms of my background, again, my name is Jim Busch. I post under the Growth Trader handle. The ticker for that is SETUPX. And I invest primarily in small to mid-cap growth ideas. I'm a hybrid fundamental and technical analyst, so I use both approaches about equally. I consider myself a position trader with holding periods generally measured in weeks to months. Lately, it's been sort of a choppy market for my style, so I've been getting stopped out of a number of my ideas, but generally speaking, I like to hold stocks for several months at a time to let them play out. And finally, I'm the manager of Briefing.com's idea generation team, and that covers the emerging growth stocks, liquid momentum, value leaders, and the next big thing features. So, how do you define an early stage idea? It's important to establish this up front because there are plenty of other growth stock ideas that can work and can make you money, but I'm just not going to be covering those today. With me, in terms of early stage ideas, I think of those as smaller, younger companies. Generally, market caps are well below $1 billion with good growth characteristics. I'm looking for a compelling story that's not yet well known. Generally, I'm looking for a major catalyst surrounding this stock. So, for example, either they've just reported their sort of breakout quarter, one of those out of the blue, stronger than expected quarters that no one was expecting, or a transformative news item such as an acquisition or an industry event that's positive for them or something like that. But I'm looking for a name that has either just experienced that catalyst, in other words, it's just starting to sort of break higher, or the chart suggests that it's just kind of waiting for that catalyst. And finally, I'm looking for a technical pattern that suggests that the stock has yet to experience its primary accumulation phase. I mean, that's just kind of a fancy way of saying I'm looking for stocks that haven't been running for 3 or 4 years straight. So let's just walk through the process and the specific steps that I do. The first thing I do is I review the weekly charts of recent IPOs. Again, I'm looking for younger companies, and those are typically found amongst recent IPOs. And by recent, I'm using sort of a loose definition of that. I'm going back several years. And for those stocks with promising chart patterns, I'll apply fundamental screening criteria to those. And for those that pass the technical and fundamental criteria, I'll learn the story and what the catalysts are. And then I'll further narrow it down to the companies that have story stock potential, and I'll go through that a little bit later on. So let's take each one of these in turn. And again, by the way, if you have any questions at any time during the webinar, you can just put them in the chat and I'll get to them during the Q&A. So let's start with the first one, chart characteristics. So among companies that have had their IPO within the past 5 years, and really it could be the last 3, 4, 5 years, what I'm doing is basically just flipping through charts. So I'll get a list of all the IPOs within the last few years, set my chart to the weekly and just flip through them quickly. And that might seem like an intimidating thing because you're probably dealing with a list of several hundred IPOs. But honestly, I've gone through several years worth of IPOs in about an hour. Once you know what you're looking for, you can just click right through. And I'll tell you later on how you can easily get a list of those IPOs as well, so you don't have to do it manually. So once I have those lists, and once I have that list, I'm looking at the weekly charts. I'm specifically looking for stocks whose weekly charts have carved out a broadly sideways range. And what I mean by that, it's pretty self-explanatory. I'm looking for stocks that basically they had their IPO, and for one reason or another, they've just been moving sideways since then. And they've basically been in a holding pattern. That's probably the best way to put it. And it's a long-term base. It's a holding pattern. Investors are waiting for that catalyst to either break it out or break it down from that sideways range. So along with that, I'll ignore stocks that have already been running for several years straight. Again, those can make for good investments, but that's not what I'm looking for with this particular strategy. I'm looking for early stage growth stories, in other words, ones that haven't already gone on their big run. And I'll also ignore charts that are noisy and erratic. And that last one is very subjective, but it's an important one to keep in mind as well, because oftentimes noisy and erratic charts are very faulty patterns. So once I've gone through that list, I've flipped through a couple hundred charts. Again, it just might take an hour to do it. I'll usually come up with maybe anywhere from 10 to 15 tickers where they sort of fit that long sideways base that I'm looking for. So it's a fairly small number once you get past through that initial step. And then I apply some just very basic primary screening criteria to those. And the first and probably most important one for me is just quarterly revenue growth. And I'm looking for it in the top 3 deciles. That just means it's in the top 30% quarterly revenue growth among all stocks. If you can't screen for deciles or percentiles, that's fine. Currently, what this equates to is about 20% or higher quarterly sales growth. So you can just set your screener for the absolute number as well. That's simple enough. But revenue growth to me is the most important metric because really it's the best shorthand number for business momentum. A company that's putting up 20%, 30%, 40% quarterly revenue growth quarter after quarter has very strong business momentum. Now, some companies sort of juice their revenue growth with acquisitions. They're sort of roll-up companies, so you do need to make sure that this is sort of product-driven revenue growth as opposed to M&A-driven revenue growth. But aside from that, your revenue growth really is your best measure of business momentum. After that, I look at gross margins, and I usually set a floor, say gross margins. I don't want it to be any lower than 25%, and that's an arbitrary number, but it works well because what it does is it removes sort of the commodity-driven companies and the real cyclical plays, and again, those can be good investments at certain times of the cycle, but they're not what I'm looking for here. Again, I'm looking for young growth companies. And gross margins is actually sort of a good proxy for, I guess you could say, pricing power. because companies that have sort of unique products and unique IP or unique concepts tend to have higher gross margins. So that's sort of an easy kind of screen to get out the real cyclical commodity-related names. Looking for a low long-term debt-to-capital ratio, I think that's pretty self-explanatory. And with the 6-month relative strength rank, I set it pretty loose. I'm looking for just anything greater than about 60, because these stocks that have these weekly chart patterns that are just moving sideways, I mean, those aren't your strongest stocks in the market, so they're not going to have that real top-notch relative strength rank. So they're still consolidating. And so as long as they're above 60, I know they're still outperforming the market by a small amount, so I'm comfortable with that if they're putting together a nice consolidation. Now, once I've gone through these fairly simple screening criteria, that'll take that 10 to 15 stock list typically down to about a half a dozen or so. And then I'll look at some secondary data points. For example, I said revenue growth is my most important metric. Does the company have sequential increases in sales? I'm not talking about sales growth here. I'm talking about the absolute number. So is it each quarter, is it going from 20 million to 22 million to 25 million to 27 million? That isn't, I don't insist on sequential increases in sales, but it's nice to see it because it means that their sales are strong enough that they're not, they're sort of outgrowing any seasonal aspects to their business. It suggests that they have a very strong product momentum. And then I have a question mark next to profitability and EPS growth. And the reason why I have that is because younger companies that are early in their growth phase, they tend to have very fast revenue growth, but in many cases, management will make the decision to sort of plow that revenue right back into sales and marketing and R&D in order to position the company better for the long haul. So essentially, they're making a conscious decision to sacrifice near-term profitability and margins for kind of the long-term opportunity that they see ahead of them. So while it's nice to see profitability and good EPS growth, I mean, I definitely prefer to see that. I'm not going to fault a company if they have really fast revenue growth for being in that investment mode phase. You see that quite often. So you don't want to exclude them right off the bat is basically my point. Operating margins sort of follows the last bullet point in terms of profitability. Higher is always better, but often with young growth companies, you don't necessarily penalize them if they're investing in the business right now. Float is one of those metrics where generally the lower the better. If some of you are unfamiliar with sort of how float works, that's just the amount of publicly available shares that can be traded. So if you have a very small float, say 5 million shares, investors are going to have to, that means there's a very low supply of shares available. Investors are going to have to bid up to buy those shares, and it's just a good, it's usually a positive when it comes to these stocks. If a company has a large float, say 80 million shares or 100 million shares, I mean, that's not necessarily a negative, but just on balance, it's nice to see a low float if everything else checks out. Okay. And finally, with these secondary data points, I don't pay too much attention to valuation. When it comes to growth stocks, I mean, oftentimes with the really unique ones, they deserve a premium multiple, and they can trade at an egregious multiple for a lot longer than you think they can. So in terms of the forward enterprise value to sales that I look at, and by the way, if you're not familiar with that, that's very similar to price to sales. If it seems high, I don't necessarily see it as a negative. But if it's on the very low end, so for example, if the forward EV to sales is less than 1 or the forward price to sales is less than 1, I actually view that as a positive because oftentimes if everything else looks good, the growth story is good, the business is kind of humming along, They've kind of had that big quarter that gets the stock moving, and everything looks good there, and then you look at the valuation and it's trading at a price to sales of less than 1. That stock can often move a lot farther than you think it will, just because the valuation gap is probably so wide between that company and its peers that it can just keep on running far beyond where you think it can. So again, we're sort of at half a dozen stocks right now. After we've flipped through all those charts, looked for the sideways patterns, those long-term trading ranges that have developed, we've applied our fundamental criteria that kind of whittles it down a little bit further to maybe 5 or 6 stocks. And then what I'll do is, then it comes to the purely subjective part, and this is actually a really important part of it, because when I'm looking for story stocks, what I'm talking about there is a commercial stage company. In other words, they already have products on the market, they're already selling, they already have revenues, so this excludes biotechs and kind of hope stocks. These are real businesses, and they combine a unique product or concept with strong business momentum. So in other words, things are already working for them right now. Investors and funds love these types of stocks because there's something unique about them, and it creates a scarcity value, and people are willing to bid up to buy these stocks. And that's what I'm particularly looking for, as opposed to a company that's sort of in, maybe it's not a low-tech business, but maybe they sell, 24 different products that they don't have a lot of intellectual property associated with them, and some are doing well and some are doing poorly, but those are the ones I'm not too interested. I want the ones that have something unique and that people are really willing to pay a premium for. And what you really have to do is you have to review each company, learn what they do, understand what the catalysts are for that particular story and how unique it is. And I find the easiest way to do that is to listen to the recent conference calls, and particularly the investor presentations, because in the presentations, management usually does a pretty good job of kind of walking you through the big picture story, whereas the conference calls are more kind of drilling down into the quarter. But those are the two best things that I know to really get a sense of the company: the conference calls and the investor presentations. If they don't have those available on their company website, the 10K isn't a bad place to go either, because even though you have to sort of wade through a lot of boilerplate information, you can usually get a pretty full story by reading through there. And again, putting this work into it, the goal is to uncover just that handful of story stocks that have the potential to become new market leaders, because that's really what you're looking for in terms of an early stage growth idea, is a small cap company with a really unique product or concept that can become a big cap while you hold it. So we'll talk a little bit more about these characteristics, just to sort of flesh the idea out a bit. And we're talking about a new or disruptive product, technology, or concept. So it could be a technology company, an equipment provider, cloud software, medical technology, or it could be a retailer that comes up with a unique concept. They should have a narrow focus. In other words, they should just be targeting, say, either one product or a very defined vertical or set of verticals. They should be gaining market share and have pricing power. And lastly, this one isn't mandatory, but I like to see the potential for operating margin expansion. But this also goes back to that whole profitability thing, where sometimes these companies are in investment mode for a year or two, and they're going to be sacrificing their operating margin to build out their sales and marketing and R&D. So sometimes that doesn't come into play here, but especially for the ones that are profitable or just recently turned profitable, it's always a really good catalyst to see the potential for significant operating margin expansion. So when it comes to these criteria here, maybe the best thing to do is just kind of give you a a sense of, when I listen to conference calls, and I've listened to a lot of them over the years, there's a very consistent theme that tends to come up among the companies that I listen to. Again, the younger growth companies. These tend to be very, very targeted, sort of hungry companies, small caps, mid caps. They have one product or just a small number of products that target a very specific niche, and they'll almost always say during their calls, an analyst may ask them, so how's the competitive landscape? And they'll say, well, we compete against some big companies out there, Cisco, IBM, Hewlett-Packard, Oracle, basically sort of the usual suspects when it comes to the tech behemoths out there. And they'll almost always say, yeah, we're taking share from them. And it's really like it reminds me of a note I read several months ago where an analyst was describing one of these companies, and he was talking about how they're taking a lot of share from Cisco, and he referred to that company as a share donor. And I think that's just the perfect description for these big legacy companies like IBM and HP and Cisco. I mean, some investors may think, well, a small company competing against a huge company like that with all their resources, it's going to be an uphill battle. But these smaller companies that are focused generally have much better technology. They're, again, much more focused on their niche, and they're going up against these huge competitors that are just all about bundling. Generally, their technology is several years behind. They're not focused on that vertical or segment. They may have taken their eyes completely off the ball, as a matter of fact, or that's often the case. And generally speaking, it just leaves the field sort of wide open for these smaller companies to just come up and take as much share as they can. And that's exactly what I'm looking for in terms of a story stock. That pretty much sums it up. When you're listening to the conference call and you hear commentary like that, that's a big tip-off that this could be a leader here. So let's walk through some examples. For those who've listened to any of my previous presentations, some of these, the first two examples will probably be familiar, but I wanted to include them here because they're just very clean examples of what I'm talking about. And then I'll go to two more recent examples that are maybe a little bit less clear-cut because, sometimes there's some ambiguity in this. Sometimes when you're going through those chart patterns, you get a really clear-cut one and the story checks out perfectly and it's very obvious to you that this is a good name to follow up on. And other times, not everything checks out and you have to do a little more interpretation. So let's go through the clean ones first. So this is ServiceNow. This is one that I was talking about quite a bit in April of 2013. And so I came upon this one again as I was flipping through the weekly charts of recent IPOs. ServiceNow went public in June of 2012 and had a strong debut, like a lot of cloud software plays. I'll get into what they do in a minute. And then the stock just kind of cooled off for the next 7 months or so. And there are various reasons for that. I mean, there are some negative seeking alpha stories on it. There was a big lockup expiration. There were a few things out there, but nothing terribly concerning. But it just sort of marked time and basically formed this really nice consolidation pattern. Some might refer to this as a cup with handle, and I guess that's pretty accurate. To me, it just looks like a really nice sort of sideways kind of range-bound pattern where the stock was just waiting. You could tell it was just waiting for a catalyst to break it out. So when I came across this chart, when I was flipping through all those weekly charts, it immediately reminded me, okay, I need to reread this one again because it had been a while since I looked at it. So here's what they do in terms of those fundamental criteria. And again, this is as of April 2013 when I was looking at that chart. Everything checked out great. In terms of just the metrics themselves, revenue growth was exceptionally strong at 81%, gross margin 62% and rising, no debt, a small loss, but ServiceNow is cash flow positive, and pretty good relative strength, about 84%, or I'm sorry, about 84. And for a stock that's consolidating sideways, that's pretty good. Now, in terms of does ServiceNow qualify as sort of that story stock, and it definitely did. I mean, they were the first IPO out there that offered cloud IT services management software. And basically what that is that, think of it this way, they sell it to large multinationals, and it's a cloud-based sort of dashboard that can track and monitor and allows IT professionals to manage sort of these sprawling IT assets for that company. So you can see how it would be a very valuable thing. And they compete against BMC, Hewlett-Packard, IBM, and those other very large rivals are generally just selling just ancient software. It's on-premise, it's sort of 20-year-old technology, and ServiceNow has just been sort of running laps around them. And they're very focused, as you might think. Every call they're talking about how they're gaining share, have great pricing power, they have potential for operating margin expansion, but they're also in investment mode then, and they are now as well. But everything checked out for this one. And just so you have an idea of what it's done since then, it's actually done quite well. So we'll move on to a second one that I think represents a pretty clean example. This is another one I've talked about before. This is Imperva. This was another one that I was talking about in April of 2013. And very similar thing. IPO in November 2011, strong out of the gates because they do security software and appliances, which was a hot area given all the reports of hacking we seem to get every week. And then it just kind of cooled off and went sideways for a year. And again, there were a number of reasons for that. But as I was flipping through the weekly charts, and I came across this one, this one, again, just jumped out at me as just a beautiful kind of sideways pattern, where this one is just waiting for a catalyst. And reminded me, okay, I need to take another look at these fundamentals because I didn't really quite remember what they did from their IPO. So again, this one checked out great. This is as of April 2013. Revenue growth strong, very good gross margins, no debt, already profitable, a decent relative strength, but again, it's moving sideways, so 74 is pretty good. In terms of the story stock criteria, yeah, I mean, they make security software and appliances aimed specifically at data centers, which previously wasn't even really a category. So the security industry is just, it's a zero-sum game. Anyone who's gaining share in firewalls and sort of endpoint security is doing it at the expense of someone else because it's just saturated and has been for a long time. Whereas Imperva is basically selling into a new category. It's not a rip and replace type of deals they do. These are new sales, so they're not replacing someone. These are brand new security appliances that are considered an extra layer of security, and they're very focused on that. They're gaining share in the sense, I mean, they do have competitors, but it's pretty wide open, and basically everything checked out. It was just a very good story, and this is what it's done since then. One of the reasons why I also included Imperva was because it had a beautiful breakout after that, and then just a nasty type of shakeout afterwards. They had two kind of rocky quarters. They had some sales execution issues, and then they recently made an acquisition that they had to really explain to people, or a series of acquisitions that they had to explain. But it had a pullback that probably shook out a lot of people and tested a lot of investors' patience, and this does happen. But it rebounded nicely, and it's trading at new highs these days. I would imagine that people who got in for the initial breakout probably had to re-enter it towards the end of the year after getting shaken out. But it certainly does happen. These things can make for wild rides at times. But again, it had just a textbook chart pattern and everything lined up, and it actually went on a really nice run. So let's go on to two others that were a little bit more ambiguous at the time that I came across them. So Fluidigm is a name that I wrote up in August of last year. If you look at the chart here, this is borderline noisy. Remember early on I said that I avoid charts that are noisy and erratic. I mean, this certainly is borderline here. But it also is that it has a clear sideways bias too. So it does fit that of what I'm looking for, even though it's noisier than I liked. But what really made me sit up and take notice with Fluidigm was their Q2 earnings report on August 1st was just completely out of the blue. I mean, I think since their 2011 IPO, I don't think anyone was following this stock anymore. I mean, that's pretty evident from the chart itself. But they reported this just blowout Q2 beat and raise. And I think it really just sort of turned people, even people who were familiar with them, and it's like, whoa, where did this come from? And all of a sudden, here you had a company that business was really booming for them. And based on the chart, it was pretty likely that few people had a full position in this one. So that's when, I take a look at the fundamentals in a little more detail right there. So even though this one had technically already broken out by the time that I came across it, it's still very early stage. I mean, if you look at this, it's still just above that long-term trading range. So I can't look at that, even though it ran 2 points from 17 to 19 as a result of that earnings report, and it was trading at kind of nominal new highs. You still can't say that, this has been running for a long time. It's still very early in a potential run. So I looked at all the metrics, and they checked out nicely. Revenue growth was strong at 35%. Gross margin was actually the strongest in their industry at 72%. No debt. Small losses. They're in investment mode like so many other younger companies. Good relative strength, 91. And when you look at sort of the story aspect of it, they were actually pretty unique. They operate, or they target, the single-cell genomics market, which is sort of this cutting-edge emerging field within research. And this is a field that is very new, and it only has about a 300 million addressable market. That's what it's estimated to be. So it's sizable, but it's too small for the larger players, such as Illumina or Life Sciences or Roche, to get involved in. So Fluidigm, for the most part, has it to themselves. I mean, there are other competitors there, but they have a lot of patented technology, and they've been gaining share and have had very strong growth, and they've been doing very well. So the metrics check out. The story is a unique one, and Fluidigm turned out to be a really nice play. That's what it did after I started discussing it in August. I certainly didn't expect it to go up in such a vertical manner, but turns out it had a really nice run. And the fourth example that we'll go through right now is, this is Horizon Pharma. I don't know how many of you are familiar with this one, but this is one that I wrote about in November. And I actually didn't come across this one as a result of sort of this process that I've been talking about, where I'm flipping through the weekly charts, starting at that aspect. I came across it because of a news item that came out and gapped it up. And then when I looked at the weekly chart, it fits into this discussion, so I thought I would include it. So they had an IPO in July 2011, and basically the 2 years that followed that IPO were just a disaster in every conceivable way. I mean, they were unprofitable. I mean, they were struggling for market share. They had litigation. They were on life support by the time 2013 rolled around. And the stock started recovering in the fall. But in November, there were really two transformative events. Number one, they had a strong Q3 earnings report. I mean, surprisingly strong, that for the first time showed that their flagship drug, it's called Duexis, accounts for 90% of sales, really started to accelerate and get some pricing power. And that was a huge catalyst, that earnings report. And then a few weeks later, they came out and said that they were acquiring a very complementary drug from AstraZeneca. And so not only did that acquisition have good synergies and will expand their sales in 2014, but most importantly, it also was an accretive deal that meant that they were going to turn profitable much sooner than people had anticipated. It moved profitability up several quarters into a near-term event as opposed to kind of a longer-term event. And this kind of overnight just changed the whole dynamic with this stock. So this is what the chart looked like in November when I wrote it up, and it really does fit into this recent IPO kind of early stage category. So let's look at the fundamentals. I mean, at the time in November, revenue growth was exceptionally strong, triple digits, gross margin 80%. They had a fair amount of debt, which, you know, that sort of approaches my comfort level, but debt isn't the same negative that it used to be. They were reporting small losses, but that became sort of immaterial because of the way that Q3 earnings report and the that accretive acquisition was, and good relative strength. And in terms of the story stock aspect here, they didn't, you know, Horizon Pharma didn't have a new product or a concept. They're a specialty pharma maker. Duexis is 90% of sales. So they didn't have anything new there, but they did have new catalysts. So that was the key thing there. All of a sudden they had new product momentum. They had an acquired product that would be recognized in sales beginning in 2014. And, you know, the biggest catalyst obviously was that profitability was getting moved up. So, you know, you have to, there was something new there, but it wasn't kind of the traditional way of looking at it. Again, narrow focus, gaining market share, pricing power, all of these are recent things, and definitely have the potential for margin expansion as they approach profitability. And this is how it's done since. It finally broke above that resistance level near 8.5 or so, and just sort of continued higher. And the nice thing about Horizon Pharma that I commented on back in November when I first flagged it for people, this goes back to that valuation aspect, was that all of a sudden you have this sort of overnight, you have this brand new growth story here as a result of that report and the M&A in November. But so all of those positives checked out. And then you looked at the valuation, and their price to sales, I mean, again, this was a company that was on life support. Their price to sales was still really reasonable. I mean, I think it was about 1.5 times. And for a specialty pharma stock that's going to be growing at such fast growth rates, even one that is still considered speculative, I mean, that's a very cheap multiple. So that was an additional catalyst that I thought applied to this one as well, that low price to sales or low EV to sales. So always check for that, even if you don't consider it a primary metric. So those are the examples. I know we've covered a fair amount of ground here. So basically what I'd like to do is just recap. It's actually a very simple process. I do this at any point during the year when I feel like I need to generate some new ideas or new forward-looking ideas. Ones, you know, stocks that haven't sort of hit that trigger yet and started on their big run. So it's a simple process. I just get a list of all the recent IPOs from the past few years, flip through the weekly charts. Again, sometimes it just takes an hour. It doesn't take that long. Look for, jot down the ones that have that kind of broad sideways pattern where it just shows, you know, this stock, it's not going down, it's not going up, it's just kind of waiting for a catalyst. That's what I'm looking for. Then once I have those names, I apply my primary and secondary growth criteria. Usually by this point, I have half a dozen names, if that. Might even just be one or two. And then, you know, I'll check out the story. I mean, oftentimes, you know, the ones that you have here will be sort of decent stories, but nothing that really jumps out at you. But sometimes you'll find a really good one. This is something where once you've looked into it, everything lines up. But for some reason or another, investors are just taking a wait-and-see approach to it. And like I said, the chart just screams that kind of all the pieces are there, but they're just waiting for a catalyst. And oftentimes, that catalyst will come around earnings season. That's when sort of your best buy triggers will occur. It could be maybe even leading up to earnings season. It might start breaking out and running ahead of the earnings report. Oftentimes, it'll wait for the earnings report and then gap above the range. But don't let necessarily that gap put you off. Because again, for a stock that's been moving sideways for 2 to 3 years, if all of a sudden the story has changed from kind of a sideways, no one cares about this stock, to a new growth story that funds will want to accumulate. I mean, the fact that it gapped maybe 5% above that long-term range top, still in the early stages of a run, or the odds are it's still in the early stages of a run. So these are particularly good to watch for during earnings season. In fact, what I'll often do before, well in advance of earnings season, is trying to flip through these, get a handful of names that I can just put on my watch list. They haven't broken out yet. They don't look like they're going to break out anytime soon, but I'll make sure that I know when their earnings dates are, and I'll watch for them when they report. I'll be watching. If they look like they have that breakout quarter and they gap up, and it looks like they're going to break out above that resistance, and that quarter is really going to represent that sort of fulcrum point in the chart, then I'll be prepared for it. So like I said, this is sort of a simple process. It actually doesn't take too much work. You just sort of have to do it a few times, and by then you'll really know what you're looking for, and it becomes very simple. So I know that some people have access to good screening software. Some people have institutional quality screening software and charting software, and some people don't. And for those who don't, we actually do quite a bit of the work for you. So, for example, in terms of just getting the IPOs, say the list of recent IPOs, at the bottom, the next big thing is our IPO analysis feature. And every Friday we put out a report that analyzes the new IPOs for the following week. And that contains all the fundamental analysis about these upcoming deals. But at the very bottom of that report, it also has a running list of the past 6 months IPOs. So it's very easy just to grab those tickers at the bottom of the next big thing and kind of piece together several years. Again, shouldn't take you more than 20 minutes to do it. So that's what I would suggest. And then if you ever need to go back and kind of read up on any of these names, we've already done at least the initial pre-IPO fundamental analysis, and that can give you kind of a jump start on these. I would also look at emerging growth stocks. These are high relative strength, small to mid-cap growth stocks. Generally, the ones that appear here have very high relative strength. So in other words, for this discussion, this will catch some of those names that have broken out from these long-term bases and are seeing a very strong move higher. So their relative strength is going to be in the 90s. So they might look fairly extended. It might be 1 or 2 months into the run, but it'll still catch these really strong breakouts from the long-term basis. You just have to look for them. Just keep in mind they might be extended on a near-term basis, though. So that's those are the two resources that I would encourage you to look for, especially if you don't have sort of some high-level screening software. We've done most of the work for you between these two resources. So this leaves time for the Q&A. Again, please, if you have any questions, just put it in the chat, and I'll get to it when I can. And if you can, just give me about 20 seconds to review the questions, and I'll start answering them. Okay, so I'm getting a lot of questions about specific names, and so I can hit those. That's fine. One person is asking whether Tesla ever hit your trigger. And Tesla definitely did on the purely technical and a purely technical aspect. This was way back when Tesla was sort of did nothing, if you remember, for the first year or more after its IPO. Just kind of grinded maybe a little bit higher after its IPO, but it didn't do much because it was still very much a concept stock. So I did pick it up on the initial breakout, but the fundamentals weren't really there for me. Obviously, I had no idea it was going to go from 20 or 30 to 200. If I had, I would have gotten in it anyway and ignored the fundamentals. But that's one that all the pieces didn't quite fit for that one in terms of what I look for, unfortunately. Another person asked, do you have any recent examples or much more recent examples to look at for stocks that sort of fit this method? The further along we get in this bull market, the harder it is to find these names. I mean, it seems like every weekly chart you pull up, the price starts in the lower left-hand corner and it ends in the upper right-hand corner. So they are getting fewer and fewer, or you're seeing fewer and fewer of these. And one that I would point out to you is called NetScout. The ticker is NTCT. And they broke out a couple months ago. They had a good report. In fact, they had two good reports, I think in November and in January, if I remember correctly. But if you look at the weekly chart on that one, it hasn't advanced that far from that initial breakout zone. And again, I'm doing this from memory. So if that one pulls back, if we ever get a market correction and NetScout pulls back and kind of holds that break, sort of starts carving out a new range above that breakout zone, I would definitely be looking at that one, because that's definitely an intriguing name, I think. That's one of the more interesting ones I've come across recently. But the initial breakout was a couple months ago. So someone asked me about, let me see. Someone asked me about, just move over here, blocks and AMBA. Blocks is actually one that I had been commenting on a lot over the past year or so. It was actually one of my favorite names back during that same period when I was talking about ServiceNow and Imperva. I was also talking about blocks, and the stock itself turned into my nemesis. It just kept shaking me out. But if you look back in the SETUPX archive at around that time, around March, April of 2013, you'll see I was talking about it a lot, and I was kind of pounding the table on that one because the chart pattern and the fundamentals and everything just kind of screamed story stock on that one. But it kept shaking me out. It was just kind of such a loose pattern that I just couldn't hang on to it, and of course it broke out and went on a really nice run. So yes, blocks absolutely was one that got picked up. Also asked about AMBA. AMBA actually did not come up on mine, but our lead IPO analyst, who's in charge of the next big thing, caught that one in the single digits, and he was all over that one. So he has more of a GARP criteria, growth at a reasonable price, and he nailed that one. So I'll kind of defer to him when it comes to AMBA. Someone asked me, is this webinar recorded? Yes, it is. We'll post the replay tomorrow to the site. So if you want to review it at a later date, or if you know someone that missed it, we'll have it up on our YouTube page. Which software do I use for screening? I use a few different things. I screen using FactSet, which is an institutional service, but I've also used MarketSmith is very good. That one seems to get better every year. TradeStation, I do a little bit of screening in TradeStation, although that one has its pluses and minuses. So those are the ones that I use. And someone followed up whether I have any brand new charts or just using the August and November examples just for discussions, and that really was the case. I wasn't basically I'm just trying to illustrate a strategy here, so I wanted to use past examples, There aren't that many that are popping up right now during earnings season that I could use as brand new ones. But if there are any new ones, I'm always posting them to the service. So that's actually a broader answer to this question. Basically, whenever I run these screens and do the strategy, I post the results to the service, or I'll write about it individually when I see it. So you'll always be able to find those. It's not as though I'm kind of running it on my own here and and not letting people know about it. When I see a really good one, I'll let readers know. And again, I post those under the SETUPX ticker. So you can always go into the SETUPX archive to see examples of that. Someone asked about IPO strategy and fundamentals. Is there a good book or resource that you can get for that? Honestly, I would say I don't know about it. One of the nice things about the next big thing feature on briefing is that it seems as though we're really the only service that does a good job of providing fundamental analysis of new IPOs. And for one reason or another, I'm not sure. There's kind of a lot of stuff out there on new IPOs, but I don't think a lot of it's very reliable or very good, and the books that are out there are just almost too general to really be of any use. So my question, maybe I'm a little bit biased, but I would say just read the next big thing, and you'll see what we're looking for, and you'll see the techniques we use, and you'll probably get a pretty good feel for it. Someone asked if I'm on Twitter. I'm actually not. It's just, there are only so many things I can keep up to date with. I'm actually not that active on social media. I'm actually very inactive on social media. So you can always contact me here at Briefing by shooting me an email. If you want to contact me directly, you can send an email to jbusch, so JBUSCH @briefing.com. It's about as far as I go with the social media. Let me see. We have time for one more, and then I'll wrap it up. I think I've basically covered just about all the questions in here. So again, we're going to wrap it up here. So please, if any other questions sort of occur to you right after this ends, or if you think about it more tomorrow or thereafter, you can always shoot an email directly to me. Again, just jbusch @briefing.com, or you can send it. We have a number of email addresses. It'll find its way to me if you send it to another briefing email address. And I always respond back. So thank you very much for your participation. Any questions or feedback about the service, please send them to sales@briefing.com. Especially for those of you who are newer users and you're on trial, a salesperson is probably the best person to answer your questions about the product. So that's going to do it for me tonight. Thank you very much, and have a good evening.